Hello and welcome back to the RA21 podcast. My name is Aaron, and as always, my co host Ryan is here with me today. We hope that you guys had a very good month in the last month since we saw you. And today we're going to talk about a very good topic called an all in topic. And before we start, Ryan, I have a good question. And how have you been doing?
I've been doing all right. Really busy. But yeah. Um, Always on top of the markets. Very volatile last month. But other than that, yeah, doing pretty all right. How are you?
Well, as usual, busy, but it's been good. It's been a good month, as always, markets up, market down, market sideways, left, right, like every single YouTuber out there, lah, market can go up, market can go down, left, right, and, as always, lah. But, I think today we have a very interesting topic to talk about because we titled this topic all in, but what it really is capital allocation, right? Because if we were to title this capital allocation, then obviously I don't think the algorithm will take it off lah, because like you need to be able to market it better so that people will be like kind of interested in understanding what this is. And I guess before we start, right, like I guess the first question I want to ask is what is all into you, Ryan?
Yeah, all in is pretty much to me very good capital allocation. It's doing a service to your money by allocating it to the places where it can grow the best, where you have the best odds to grow it at like an exponential rate over the years. If I were to put it like loosely in a definition way of speaking, I would say leave no cash uninvested. That means like 0% cash, 100% invested always.
Yeah, and I think that is a very interesting um thing that you mentioned about going all in, right? Because I think for many people, right, in from my perspective, right, they are always all in depending on their risk profile, right? Because usually there's four types of investments that people make. The first type of investment that most people like to buy is property, right? The second type of investment that people don't actually know they're investing in, and that is cash. The third is stocks, and recently, of course, there's cryptocurrency. And I think when we talk about all in, right, what we are really saying is that for most people, whether or not you like it, right, you are actually all in something, because end of the day, there's no such thing as you not allocating your money, right? Because like sometimes
Mm-hmm.
when people were to buy property, right, and then they're really like leveraged to the hill, they're paying off their mortgage by 60%, right, then you realize that their capital allocation for their future income is really 60% into property. Because when property takes up like 60% of cash flow, right, it leaves you very little room in order for you to buy actually anything else lah. And even if you buy, right, it will not be as significant as putting more than 50% of your income into a singular and concentrated bet into property, right? Then I've also met people, right, who all in cash, for like many years, and usually these very old, and these are the people who are very old auntie uncle, then they are very scared to invest their money, right? So because they're so scared that the stock market will crash because of some like doomsday article, and on recently the YouTubers don't help, right? They always like, oh, it's gonna crash, it's gonna die, we're gonna get doomsday, you guys better stock up seeds, you guys better like all this like all this like doomsday talk lah, then what
Yeah,
ends up happening, is that people just keep staying into cash, right? And then they don't invest their money, and then 10 years later the S&P 500 goes up by 3 times. Right? And of course, there's also stocks, but I guess the most common thing that people buy is stocks, because especially in the younger generation, right? People do enjoy buying stocks because the information is so readily available. You can so readily find a community, who in really good dive deep and actually understand the stock from a very fundamental as well as future seeing perspective, which is quite rare during my time. And of course, cryptocurrency, that one, we have dedicated 2 entire episodes to it. So, that's a very huge sector as well. Yeah, and, I guess in order to like further on this question, right, Ryan, what do you think is the main difference, right, between going all in investing versus holding cash?
well, it's pretty straightforward. I think we echoed this fact enough in the crypto episodes that we did in the past. It's basically just to protect yourself from inflation,
Mm-hmm.
because inflation and your taxes also is like the silent killer of your position if you have any positions in money in cash.
Uh-huh.
So um when you are invested, your money is like protected. It's not going to be eaten up by inflation. So
Mm-hmm.
that's really the main point I see when I go 100% all in on my investments and I don't hold cash.
Yeah. Have you actually like, personally like had a point in time where you held a lot of cash and you didn't invest your money?
Yeah, but it was a pretty short period, and it was not a lot of money as well. It was the time between I graduated from university and to till the time I bought my first ever stock. So that was like the point in time, like I wasn't sure what I was doing. Investing wasn't also in my mind. I didn't really know what was inflation, and I was always told like you should keep a good amount of money in your bank account before you decide to do anything else. So I just blindly saved, and yeah.
I think you know, I I I really echo a lot of your situation when you say that there was a moment in time when you held cash, right? Because that's how I started myself. When I started working, I had to find avenues for me to grow my money faster, and that's when I also started to all in since day one, lah. As a disclaimer, as I mentioned many times, I've been investing since like 2009, 2010, 2011. So it's been a good 10 years since I bought my first stock, right? And I've seen many like narratives come and go lah. You guys, a lot of the younger people, right? They always see like all this like crisis, then they always think like it's the first time that shit like this has happened. But the fact of the matter is, if you've been in the markets long enough, right, you realize that a lot of these narratives are just rotating narratives that tend to always repeat in some sort of manner, right? So it's like Harry Potter, and then every single episode is the same. Then if you watch Pokemon, every single episode is the same. Team Rocket comes, then they get killed by Pikachu. Then the Team Rocket fly out to, and then you see a twinkling star. So it's pretty much like all these like narratives, right? It's a very like wash and repeat type of narratives. There's always going to be something. There's always going to be something to worry about. And the difference between holding all in and holding cash, right? Coming back to this question, is that I have met many, many people, and there was a point of time, right, myself, right, and where I held a lot of cash, and before the COVID crash in March 2020, my cash holding percentage was 95%. I think most people, I think this is the first time I've like actually disclosed it. Like 1 year before the big COVID crash, I actually cashed out a lot of my investments. And then, honestly, I felt extremely horrible in that 1 year holding cash. You know why? Because I don't know whether or not a crash is going to come. And the reason why I did it, right, is because I kind of took the gamble that I shouldn't have, in hindsight, that valuations were out of whack lah. So I've been in a position where I've held cash many times, right, anticipating a crash, and it just so happens that when I did it before COVID, right, I was very lucky that the crash did come. But personally, if I were to go back and ask myself, right, if I could do it all again, would I have actually gone all in or whole cash? Right, I would have probably gone all in, because the fact is, there's many people, right, who did this they tend to like to say there's a crash is coming, right? But the fact is, most of them, right, pre-COVID, right, did not see COVID coming, and they did not see a crash happening, right, due to COVID, right? And this
Yeah,
is something
exactly.
which as an investor, you have to be honest with yourself, right? Because it is very easy to take a broad statement, right, and say that the crash is going to come. And then when the crash comes, you say you can either choose two ways to go around it. Like, you can either choose to say that you were right. But the question that you really have to ask is, did you really foresee the event that led up to the crash? And in most cases, right, I can tell you that 99.99999% of people out there, right, certainly did not see COVID happening, right? And then the difference between going all in, right, is that, to be honest, right, when you are having a portfolio, right, that really goes all in, what you realize is that you really just don't really have to make a lot of strategic decisions, right, going forward. Because those of you who do not know, I do speak to Ryan quite often on Instagram, right? I think there was one time, right, where he mentioned to me, which I felt it was such a good and insightful sentence, and he said that I have already done my homework, so what difference does it make about what the news actually say, right? And I think this is a very like it's very wise, because like honestly, right, that should be the narrative going forward. Because I think most people, right, the reason why they don't go all in is because they're very scared of that 10 or 20% drawdown, which we including the audience, have witnessed in the last like 90 or 120 days, right? All of us have seen it, stocks do go down, we don't just go up, right? Eventually, like, nothing goes up forever, but actually something does go up forever lah. The S&P 500, right? But eventually during this like trend up, right, there will be times and moments in times in the markets where the drawdown happen, right? And I think this is one of the biggest drawdowns that a lot of these newbies have seen since 2020, right? Because they only understand in the last 2 years it's an up market only and they don't really see down market. So a lot of them degen and go all in. But the funny thing is the moment they actually went all in, actually buy good investments, right? They managed to actually skip 10 years of understanding, right? That actually is the correct approach to take when you invest your money. which it took me 10 years to actually like get here, right? Because I've seen like 5, 6, 7 like downturns in the last 10 years of more than 15% in the S&P 500. So, and I've seen some of my stocks go down by 70, 80, 90%. And during COVID, the 5% holding which I had, one of them right went down by 95%, right? So I'm not new to seeing crashes happen. It does come, and I think for most people when they go all in, right, they have to expect that crashes will happen. But it really definitely beats holding cash in the long term, because when you hold cash, right, the most difficult thing that a person will have to do and to make a decision in is when are you going to deploy your money. And that is a very hard question to answer personally, right? Because it's like when you when you have that huge amount of money, right, and it's very comfortable, right? Maybe you can say it's 10 times your annual income, right? Most people, right, they don't have that ability and mental flexibility to go 100% in during a crash during COVID,
No,
right?
they don't. They absolutely
Yeah,
don't. It's going all in. Number one is already very psychologically grueling, and when you have like this innate fear that the market's going to dip more, what if you're not catching the absolute um bottom of the market? What if you're buying the dip and then it dips further? You won't go all in when you have all this kind of like fears behind your mind.
yeah,
It's just
especially if it's a huge amount, right?
yeah, exactly. And yeah, moreover, if you're dealing with like 5 or 6 figures worth of money, you won't go all in because that when you fear, and I think that's human nature in general. When you fear, you tend to like choose fight or flight. And
Yep.
in this kind of moments, it's it's just wiser to not go all in.
I agree. And that is what exactly happened during March of COVID in 2020. Because I clearly remember, right, March 2020, I was not even in Singapore. I was actually abroad during, and of all countries, I was in like freaking Italy, right? And like there
Ground
was a
zero.
huge, yeah, it's like literally ground zero. So it's like of all places. And I could remember very clearly, right, I was in the ground zero and I could see, right, that COVID was not as bad as what the news actually reported, as
Oh,
what
really?
Singapore news reported. It was not as bad as what it was reported. That is a fact because I was actually there. All right, I can tell from the ground zero, right, like what was reported that was happening over there is actually not as bad. People were still going their day-to-day lives. Obviously, they still had some like closures at 6 p.m., but people were still like living their lives, right? It was not as bad as what the news say. They say like, oh, it's like so disastrous, people running left, right, center. It wasn't the case. It was very calm. The place there, people are still living, people are still nice. And that gave me the confidence, right, to actually really invest my cash allocation during that time. And I was telling people on Instagram. Obviously, back then I hadn't created my Instagram handle, right? And then I was telling people, I was calling out my friends, I was telling them, you better invest right now. I say because you're waiting for a dip, right, for the last 5 years. This is it, right? I say I don't really foresee this going to like drag out, because from what I see, right, it's not as bad as what people say lah, right? So during times of a crash, it's very important, right, that people actually go down to ground zero and really check whether or not is it as bad as what the news is saying lah, right? And during that time, I think COVID, I had some sort of information advantage because I was at ground zero and I saw what was happening, and I realized it's not as bad as what people say lah, because it's pretty much a
Mm.
self-induced type of situation, right? So um personally, I went 100% during all in, right, during the March COVID crash, and I did quite well. But I would say it was combination of luck lah, because I was lucky to be in a position, right, where I could see what was happening on the ground zero. And then ever since then, I've been like 100% invested. So I hold, in fact, right now I'm more than 100% invested because I actually owe money. I actually took out a loan to actually invest more, right? And that's pretty much like the thing lah. And I could clearly remember when I was calling up people and telling them to invest their money right now, right? I can tell you, right, the large majority of people, they don't. They simply don't have that discipline and that mental flexibility to invest because they're scared it's going to dip more. And I guess this stems from human greed, right? When something dips like 20%, right? Then people, oh no, it's gonna dip further. I'm gonna buy when it dips 30%. Then when it dips 30%, no, I'm gonna wait until it goes 40%. Then when it dips 40%, no, I'm gonna wait until it's 50%. Then when it goes down to 48%, I'm gonna press the buy button, it jumps back up by 40%. I guess this is really like a function of human greed, right? Like when you want something to go low, I think it's very difficult for you to take a position, right? That you'll wait for it to go lower because eventually human greed is in all of us. You know, you want it's the same thing as when you want to sell, right? When you want to sell something, you say, okay, this is my sales price target. Okay, I'm going to wait until this price target to sell. Then when it hits the price target, I'm going to wait for it to jump by 10% more, then 20% more, then 30% more. Then when it jumps by 25%, nearly hit already, right? Then it crashes back down by 40%.
Yeah, that's usually the case.
Yeah,
I
and I
mean,
guess this
in trading in general.
Yeah, pretty much, right? So I guess like, it's not very wise to keep holding cash because you are betting on the fact, right, that you are able to make all in decisions, right, in the moments of crisis, which most people do not have, right? So I guess like, for example, if you were to take the route of all in, right, I guess the next question I would like to ask you, Ryan, is what do you think is a wise capital allocation if you have a portfolio where you go all in?
That's a really interesting question. But capital allocation, if you go all in, I would say you don't want to waste your money on things that don't matter. So that includes things like in my humble opinion, things that don't grow as much. Say like more certain value stocks, um, dividend stocks. I mean, if you take a look at like inflation is 7%, and how much is your dividend stocks yielding? I would say like at max, at the best is probably 5 or 6%. That's not enough to cover your inflation. And then we don't factor in whether the stock goes up or down. But if you want to talk about like the net gain out of your dividend stock, that's not going to be a lot. And it won't beat inflation by a mile, unlike more high growth assets like Tesla or tech in general or crypto. And while we're at it, certainly I'm not throwing shade at this, but actively manage investment funds. That's a complete waste of your time if you are going all in. If you are betting your whole net worth or your whole entire savings on some random fund manager's hands that you've never met, I would say you're crazy. But
Yeah.
because like recently we had the whole fiasco with some fund that I would not name, but and I think it's a pretty good eye opener for a lot of people.
Yeah.
That putting your entire net worth in someone's hand is just insane because these guys, they're out to earn a salary, and that salary comes from commissions and
Mhm.
trades. They certainly don't care about your money, and they will not hesitate to buy high and sell low. Yeah, I mean they're literally more degen than I am.
That's true.
At least if I buy high, I don't sell low.
Oh God, like
But yeah, I
uh
mean, but on the flip side, what my personal capital allocation is looking like is more like 60% crypto and 40% stocks. I
oh, you increase your allocation.
In crypto, yes, I did. I made like a shift in my holdings. But
Mm.
yeah, it went up. Crypto went up by 60%, and stocks are at like 40% now. And yeah, I decided to go like heavier on crypto, partially also because of like growth potentials. It's always going back to like the growth potentials for me. What has the best odds of growing 10x? What has the best fundamentals? And as much as I hate to admit it, stocks do have this glass ceiling of like valuations.
Yep.
Even if it's like a hyper growth stock like Tesla or Palantir, if their time has not come, it 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 won't do you well to like go balls deep and like hold for the next 5 years. I mean, there's nothing wrong in that, but you just have to be mentally prepared that it might not go anywhere for the next 5 years. But crypto
Mm-hmm.
is a little different. Crypto, uh, fundamentally, we see the whole world adopting crypto, and I just see a lot more certainty versus stocks if I factor in the valuations and all the uncertainties like politics and stuff like that versus crypto, because like the adoption on crypto is just massive, and that's all I need for conviction.
Yeah. And guys, if you are interested in what our take is on crypto, we have done two full entire episodes. Episode 3 and episode 1. So you guys can go and listen to it. I think we covered it very extensively. Lah. Okay, there's 3 points which Ryan mentioned, which I want to reiterate. All right. The first point that he made, right, was that about fund managers. All right, and I think that is a very good point that he has made. For those of you guys who have been following us on our Instagram channels, right, both of us have publicly declared, right, publicly said it, in late 2020, early 2021, that we completely sold out and do not recommend, we cannot say advice, we do not recommend people go with that particular robo advisor. I hate to say it that we were right, but unfortunately, I think the main reason why both of us decided to publicly come out against that particular fund manager, right, is because they make decisions, right, which we felt was very, it's not so much the fact that they reallocated the portfolio, it's the fact that they reallocated portfolio and basically didn't admit to the fact that they fucked up.
Yeah, it's all about the dishonesty, I would say. And
Yeah.
then while they are preaching, long term holds, hodl, 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 but the truth is re-optimization happens way too often.
Yeah, and their portfolio is looking more and more like a doomsday advocate, right? Because it's like they're allocating more into gold, which I don't understand why. And then if I'm the higher risk tier, why do I need 25% allocation in gold? It's quite stupid lah. Because it's like from the get go, when I invest in something, I don't want to hold commodities, right? So
Exactly.
I think it's a very like huge eye opener for most people, because this particular mutual fund manager, right, they actually have been quite popular and effective at their marketing lah. And the worst part, alright, is that when you market something and basically use your marketing, the fact is, right, when you market your services, right, and then you basically like concentrate your marketing on the fact that you have been outperforming in the last 3 to 4 years, right, and you use that as a draw for people, right, when you underperform, right, you need to prepared, right, to take the hit, right? And if you have been following the social media on this mutual fund manager, right? I think it's a huge red flag that they completely, right, do not even reply to messages at all.
Yeah,
Right,
they
it's a
don't.
huge red flag. It's a huge red flag to me. So personally, we won't name the fund manager, but I think you guys should know who we're talking about. Brian and I did mention many times that number one, we have really completely withdrawn our monies from that fund manager, and we do not really like recommend that you guys hold because I think there's it's a fundamental issue. It's not a question of like whether or not the service is good. I think this stems from bigger issues of not addressing the fact that they are basically not practicing what they preach, and I think that is something which is hugely wrong. All right, and what you can learn from that is that if you do decide to put your money to a fund manager to so-called all in, right, then you better jolly well make sure, right, that you also view them, as you have to look at their track record, right? You have to make sure that when you put money with these people, that number one, I think it's very important that they own up to their mistakes, lah. Right? If people
Yes.
make mistakes, it's fine, right? But own up. If you don't own up, right, then it's a huge red flag because it's like, then what's the difference between like you owning you and an ETF, right? So capital allocation during all in, there's many ways to do it, right? So that was the first point that Ryan made. The second point that Ryan made, I would like to summarize it as saying it will never go wrong, right, buying what you know, right? Because there are many people who come up to me and they say they prefer to buy property, they prefer to buy this particular fund, they prefer to buy China, they prefer to buy a company that they're working in sometimes, right? Some of the people who come up to me, they actually do work at Shopee, so they love buying a C Limited because they can see, how the company is operating inside, right? So that is a very huge testament to for me, right, to know as an investor, right, that the company must be doing something right for people to actually like love the company so much that they would invest the money that they're paid by the company and then invest it further into the company, right? Because it's a really huge sign, right, that the company is doing something right. And that's why for me, when I look at C, right, when I see this, right, it's a very huge green flag for me, right? That this company is doing something right, right? And that's why I talk about it, lah. But unfortunately, I don't own C because my portfolio is full, right? So the thing I want to point out is you will never go wrong, right? Owning something which you really know very detailed about, and that is why when you look at our portfolio, right, like you look at Ryan and my portfolio, we are very heavily concentrated in stocks, right, and then ideas which are very similar. Because the fact of the matter is, right, the reason why we have such high concentration into these ideas is because we know the investments very, very well. We know it very deep. We really go deep. We really understand the company. We really can see like, okay, the next 5 to 10 years what can happen. And that is really what investing really is. Because a lot of the times, right, people put money into cash and they basically like all in cash. It's very simple. You know why? Because they can't see the future. Because they're so uncertain what's going to happen in the next 5, 10 years. They've not done the homework to basically like have conviction and build the conviction and build the ability, right, to see what's going to happen in the next 5, 10 years. That's why they hold cash, right? They don't dare to
Exactly.
invest because they cannot see like, oh, like crypto is growing like is growing faster than the internet. Within 10 years we're going to hit a billion users, right? They cannot see it because they've not done the homework. So it makes it very psychologically difficult for them, right, to hold, right, especially during downturns. And a good sign of capital allocation, right, to reiterate the last point, all right, is that during huge drawdowns of like even 50% for crypto, 30% for Tesla, and then sometimes 50% for Palantir, a good capital allocation, right, you have done it right, right, is that when during a drawdown you feel absolutely nothing.
Yeah,
All
that's
right,
like a really good point.
yeah, that's a huge factor to know, right? That you have done your capital allocation very well. Personally, I've seen my portfolio take a hit in the last 90 days, right? But for me, I don't really care that much. You know why? Because I allocated my allocation very well. Because I know that a portion of my money is inside index funds. And even though index funds are down 15%, I treat my index funds like my emergency fund, right? And actually, that leads us to our next question, Ryan. And do you think emergency funds are important?
It depends where you are in your investing journey. Because this question really ties back to the fact that whether you have holding power or not.
Yeah, that's a good point.
So, if let's say I am in the early stages of my investing journey, so I'm still constructing my portfolio. I mean, yeah, lah, if you go all in, what else is there to talk about, right? Just dump all your money inside. But no, I understand that early on, you may want to have some cash buffer because yeah, maybe you're just starting out in life. You're planning to get like a new car, all that thing. So in all, in the early stages, whether emergency funds are important is it ties back to your personal finance management and
Mm, I
also
like that.
holding power. So if you know in the short term you can't hold, then don't buy,
Yep.
because that's just good personal finance management. Because if you are investing, if you follow us, we tend to invest for the ultra long term. So that's like 5 to 10 years. I mean, yeah, it's not ultra long, but it's the to some people in today's language, this is like ultra long already. But
Yep.
it ties back to whether you need the money in the short term or not, because holding power is the key factor here. If you cannot hold and some emergency happens, you will have to sell at a loss if you're going all in. That's the biggest factor. So I would say it happens more when you're in your early stages of your investments. And then when you settle down in life, generally after like 1 or 2 years of like investing in the markets, your financial situation is getting better, and you have all your shit in life sorted. Then I would say, um, don't keep cash.
Mm-hmm.
And by then, if you reach that stage at that point in time, you will probably be harnessing the power of credit cards as well.
Yep.
So
I agree.
yeah, emergency funds are really just there to make you feel safe.
Yep.
And I would say like if you are just starting out in life, or you are in a period of time where your life is a bit uncertain, then I would say keep the cash and live your life. Don't take that cash as like your bullets for investing. Just take that cash, go live life.
Yep.
And yeah, but it's all about holding power, and whether you can just hold for the long term if you're going all in.
Yep. I think your point about emergency funds, right? To keep you feel safe and secure is a very valid one, because I think end of the day, right, this is a very relative and personal question that people have to ask. Right, you go through stages of life when you're young. You have a lot of upcoming commitments. Emergency funds are really, as as they titled very eloquently, is used for emergencies. Because sometimes you don't know whether or not shit is going to happen, right? So that's why you keep an emergency fund. And the common guideline is to keep like 6 months of your emergency funds as cash, right? And I think Ryan made a very good point in that, if you don't have holding power, right, then probably it is pretty bad personal financial management, because it's like if you're like basically like spending your life in credit, then you otang many people, right, then you're like baking like bare minimum, then you shouldn't be looking at investing as your first protocol in terms of good personal financial management. You should be really looking at your cash flow and then asking whether or not you can increase your income, number one, because that's the highest return on your time instead of investing into money. And number two, if your fund size has gotten to a point, right, where you can have the luxury of making sure whether or not you don't want emergency funds, that's where you can start to explore into options of having multiple credit cards or credit cards to ensure that you have the emergency fund in credit, which is what I personally do. Right. For a very long time in my career, I always had an emergency fund, and sometimes I find that my emergency fund is too big. But it gives me that sense of false security, lah. Because I realized, like, over the years, right, I think it's very important for you to ask yourself, right, as a person, whether or not you need that much cash. Because I think a lot of people get addicted to the point that they always like to say that this cash is for emergency, right? And then what happens is that this emergency fund, right, the cash pile keeps growing and growing and growing and growing, and by the time they hit 55, they're so comfortable with the fact that this is an emergency fund. They have a lot of money, but then the money didn't grow, and it gets eaten away by inflation, right? And
Mm-hmm.
it's so important, right? Especially if you're young, get comfortable, right? To be exposed to risk and volatility, because I find that exposure to risk and volatility is a young person's game. You don't really want to like start your journey into volatility, right, in your mid 40s when you are tied down, have kids and all this, because you won't have the temperament, psychological state, right, to be able to like learn this skill set. It's something which I feel that it can be trained, and it's best to do it when you're young. That's why when I started in my career, I didn't have emergency funds. It wasn't until when I hit my mid career where I started to have a little bit of emergency funds. In fact, I always invested close to 100% of my savings into investing when I first started, right? And then even more so, I actually took on that early on to actually invest my money, right? And so I'm more than all in, right? And
I
then
think
like,
that's a really good point that you pointed out, like how you have some cash as buffer in the form of index funds.
yep,
And it goes back to like holding power in general. The longer you hold, the higher your return of investments. And then that creates that buffer that you can comfortably take profit whenever you want, because you'll be always selling stocks for a profit.
yep. And you don't even have to hold an index fund, because if you do your capital allocation well, right, your emergency fund can also be in shares that will perform during a downturn. Like for me, people always ask, Aaron, do you invest in bonds? I tell them straight, no. If I want to invest in bonds, I'll just invest in Berkshire Hathaway,
Yes.
because they're better than a bond fund, right? I had Warren Buffett. Okay, he's been underperforming, but look, this guy, his business, has $150 billion in cash, right? He's still like a brilliant investor. I'm not necessarily will get the same amount of return as the S&P 500, but I don't want so much volatility. So my option, if let's say I want to have a bond fund, right, for a person who's like, like my mom, she's like 60, right, and then she wants a bond allocation, I don't put her money inside bonds. I put her money inside Berkshire Hathaway, right? Because you when you get deep into like understanding how to allocate your capital efficiently, you start to realize, right, that there is a very huge optionality, right, for you in the investment sphere, right, to actually put your money to where your risk profile matches your investment. And I think that is something which most people don't seem to understand, because they seem to have the delusion, right, that their risk profile is always holding cash or holding property, which is not the case. Because even in the equity space, right, there exists investments, right, where it is very stable, it is very revenue generating, and it is not as volatile as you think it is, and it performs better than property and mutual funds, and that is a fact. All right, if I can literally like point out one equity that matches a risk profile, which will return better than whatever mutual fund you can buy, right, and it matches with your volatility like exposure lah, right. So like I think this emergency fund coverage, the point of the matter is, right, I would like to advise most people to don't get addicted to emergency fund, because end of the day, right, the time cost of holding too much cash is quite big. Because for a person who starts investing at age 20, right, for you to get to a million, I believe you only had to put like 250 or $300 a month. And then within a time span of 10 years, right, if you don't start investing earlier, right, then the number I think jumps up by 40 or 50%. And every single 10 years you delay your investing, right, the number just keeps going up exponentially, right? So I think the message is don't get addicted to emergency funds, because end of the day, the bigger cost is not really your opportunity cost. The bigger cost is your time, because nobody lives forever, right? Yeah. So I guess the next question is, if you have a lot of like emergency funds, right, then they're looking for deploy, right? Is waiting for the crash the right move?
This one's this question's for the people who watch like one episode of the Big Shot and then start calling for a crash.
Yeah.
But I would say not everyone's Michael Burry. Even Michael Burry did not have the balls to short Tesla through everything. And
Yes.
he in the end he just called it a trade, but fair enough, but I do not think waiting for the crash is the right move. It's like waiting for the one in the relationship.
Yeah,
It
then
will
you
never
don't want
come.
to, you will never do the work lah.
I would absolutely just like put my money down and bet where that you won't buy when the market crashes. If you're holding like that much cash, that's just in the human nature.
Yeah, actually,
Um,
if there was a bookie for that, I'll put my money on that too, because I'm pretty sure I'll win.
yeah. I mean, like we said like earlier, it's innate the human fear. I don't blame that you fear, and I absolutely don't mind that people fear as well. It's just part of human nature, and if you like think about it psychologically, it's all about when you fear, you want to do something about it. So it's
Yep.
either you run from it or you fight it, and 90% of people would choose to run away because like what happens if it keeps deeping.
Yep.
Only people who knows what the hell is happening, which is the 10%, will actually deploy capital. I'm not going to say like everyone won't buy when it crashes, because like Aaron mentioned, he was sitting on 95% cash before the COVID crash.
Yep.
And that's the example of like the 10% that I'm talking about. It's like you actually know what the hell is happening. You literally sell high, buy low.
Yeah. For full disclosure, I'm not that smart. I think I was more lucky. To be honest, because as I mentioned, right, I did not foresee COVID happening.
Hmm.
Yeah, my positioning was due to the fact that I find that markets were expensive and I needed a catalyst, so that's why I got out. But for full disclosure, I think that one was really
Pure
dumb
luck.
luck. It was pure luck. I admit it. I acknowledge it.
But yeah, that's why I say it's 90% of the time people won't buy. And it's not just me who says this. Warren Buffett also echoes the same thing. He always says that the best time to invest is now, although he's holding like I don't know how many 100 over billion in cash now.
Yep.
But he is deploying capital in some places. It's just
Yep.
and also he in his latest shareholder meeting he did admit that it was uh failure on his part to fail to find like investments that met his criteria. But he is deploying capital in certain places like Japan and all that. They were pretty good investments in my opinion.
Yep.
But in general, it's always a good time to invest if you have like a long-term vision and
Yep.
you DCA consistently, because it's just impossible to time the market.
Yeah, I think people who always echo like I can time the market, right? Usually these are the people who get 2 to 3% returns every year, lah. Because in the end, end up sticking their money into treasury funds or fixed deposits. I mean, this is a fact, all right. I've not met a single person, right, who tell me that they're going to buy a dip who actually bought the dip. None,
Yeah,
right? Like
none.
even for me, when I buy, right, I was lucky, right? And before that, my backdrop is that I have a propensity and habit to actually like really double down on my investments and really go very deep and invest a lot. So I think my example should not be used because I think I was lucky, right? And then like I think end of the day, right, waiting for a crash and then is really not the right thing because numerically, right? Okay, let me give you an example. Bitcoin, right? Let's take Bitcoin for example, right? 90% of Bitcoin upside, right? Since the creation of Bitcoin, right? 11 years, for 11 years, right? You know how many days were responsible for 90% of Bitcoin's upside?
It's probably less than 10% of the days, right?
Yeah, it's not even 10%. You take the numbers and you calculate, right? 63 days.
Wow.
Okay, in 11 years of Bitcoin holding, if you had missed 63 days, right, of holding Bitcoin or buying in, right, you would have literally lost 90% of the upside of Bitcoin.
I think
That is
same
not,
goes for this analysis done by a bank on the S&P 500. If you miss the 10 best days since
yep,
2008, I think,
yep,
you would have exponentially lower returns.
yep. And we have seen the perfect example in the last week. How much
Yep.
did Crab jump in one day?
My God.
How much did Crab jump in one day? You tell me 40%. And who missed the 40% jump? I don't want to name the person. I don't want to name them. They missed one day, one day at the jump, but jump very big. But that is a very good example of why you don't fucking like
Wait,
time the market.
exactly.
Right, because like you realize that okay, so statistic aside, we have a very good example in the last week, right? People like miss 40% jump, right? And we also have and I have given you, right? And if you actually were to equate in terms of percentage, right, where Bitcoin the best days, right, that is equal to 90% of the return, is only less than 2%.
The money is made in the waiting. You are waiting for that for this 63 days. You are really waiting for this 63 days because a lot of people don't understand volatility does happen to the downside, but it also happens on the upside. And as rare as it is to the that it wicks down, there's also times where it wicks up, which is even more rare, and you hold for times like this.
Yes, and I can tell you, I've been following like Bitcoin technicals, just as a just for fun, right? I can tell you, every time it wakes up, right, every single technical person I know got that fucking thing wrong. They got the call wrong. Every single one of them got it wrong. They never like foresee the jump at all. Completely, every single one of them got it wrong. They got the downside wrong. They got the upside wrong. They got the left and they got the right wrong. So nobody knows. Okay, what I only know as an investor is that in 10 years, right, I'm pretty sure this network will get bigger. That is what I'm very certain in. And that is why people like Warren Buffett, people like Peter Lynch, right, a lot of these people, right, they don't focus on what is going to happen the next week, the next month, because they don't know. They admit they don't know. And that's why they're so smart and that's why they're such good investors because they look 5, 10, 15 years down the road. It's exactly the same as to why Jeff Bezos is the richest man on earth because when his shares crashed 95% during the dot-com bubble, right, he could see 10 years ahead this business is going to work,
Mhm.
right? And I think a lot of this like waiting for the crash things, people seem to believe they have this god-given ability to be able to time the market and basically have nothing to show for it,
I mean,
right?
the attempt to buy low and sell the top, it's just a lot of like time wasted, in my opinion. You can never catch the absolute top. You can never catch the absolute bottom. Technicals and your so-called algorithms, they're not gonna help you because unless you are judged based on a day-to-day basis, then probably, yeah, that's something that you might want to take a look into. But for 90% of the people out there, we are not traders by profession.
Yeah, even if you are a trader by profession, right, you can look at the biggest bet that George Soros made, right? Right, that fellow, right, he didn't. The trade came. Let me be very clear. People who like to use George Soros as an example, if you really go down deep and look at how he made money, right, from the ringgit, and the pound, right? He let the trade come to him. He made a big bet, right, when the trades were in his favor, and that's why he made a lot of money. He didn't. I think it's going to crash, therefore I make that bet. No, he didn't. He let the trade unwind, and then when he saw it, he went leverage up, and that's how he made a lot of money. And I think a lot of people believe that he made money by actually like being able to see 6 months. No, he didn't. He actually like doubled down on his bet, right, when it was going in his favor, and that's why he's such a good trader.
Also, technically, he rode the wave down.
Yeah, precisely.
That doesn't really make a difference if you're riding the wave up. It's equally degen in both ways.
Yeah, he didn't. Look, he's the original degen. Okay, everybody who say like or AME, I say, all right, look, the original degen now is George Soros. All right, he basically like rode the wave, right? He didn't give a shit about whether or not fundamentally it was going to happen, but he basically was the original GME. And the fact is that he actually made money, which most people can't. A lot of people bought AMC, GME. How many of them made money?
Yeah, he knows when to close his trade. That's like the differentiating factor between him and like most people, I would say.
Yeah, I would say the key point that you write there is like if you are going to trade, then I think also like being able to take profit is also something which is another like skill set lah. Because it's easy to ride the wave, but getting out of the wave, that's difficult.
Yes.
Right. So yeah, so like I think we covered the waiting for a crash thing, right? So assuming let's say you are all in, you have a fully invested portfolio, then I think a lot of I think I have this question quite often is that how do you deal with the FUD, right? When you have 100% all in portfolio, how do you deal with it?
I would say like in the beginning, FUD is extra sensitive when I was all in.
Yep.
It affected me more than it should have.
Yeah, I can imagine.
Looking back, I think just talking to you over that few months, I think it was like back last year, November, December. I think you were getting a bit fed up with me as well.
I felt like a therapy session. I was like, yeah, it did feel like therapy. But look, you weren't the only one.
As I that was like what led me to do like the cleanse content cleanse because
Yeah.
it was getting toxic. It was really getting toxic, and I couldn't take it. And
Yep.
so I just went to do a content cleanse. I unsubbed from uh people like Meet Kevin, things that just don't add value. I unsubbed from the mass media, and I just stopped reading news all about it and focused on my life and focused on holding, and
Yeah.
I think I'm past that now, and the most recent drawdown didn't really affect me anymore.
Oh,
So
that's
yeah, I
great.
think I think I think I kind of like grew from that, and
Yep.
the content cleanse did help a lot. What I really like got from it like was like, like how I said, like if the news is big enough, I would definitely hear it
Yep.
on social media or whatnot, and that's legit the truth. Because
Yep.
like the recent aggression on like the Ukraine and Russia, I did not foresee. I did not read that from like the newspaper or whatnot. It's all from social media,
Yep.
and it was the only thing that I found like that could like change my investments. But even then, I just decided to hold because it's temporary. I don't pay attention to like all the so-called rate hikes and by the Feds. I don't really care what they do anymore because um to be really honest, that is not your job as a long-term investor. That's the CEO's job.
Yep.
It's their job to navigate through the economic uncertainty. It's not your job. Your job is just to freaking hold.
Yep.
So yeah.
Actually, Ryan, I really appreciate that you actually share your story about your FUD cleanse and therapy sessions.
Thank you very much.
But okay, so as you can see, Ryan has already fully recovered. His 6 months clean.
Yes, I'm free from addiction now.
uh, yeah, I think okay. Look, dealing with FUD, right? Like it's very amazing for me to actually see like Ryan go through this process because I can relate to it. Because when I was first starting in investing, right, I also had to go through this entire like FUD cycle. And I can share with you guys from experience, right? every single time there's a FUD, right, is an opportunity for you to make money.
Yeah, that's very true.
Right. Every single time, right, if the news is big enough, the bigger the news, right, the bigger the opportunity. That
Yeah.
is something, right, you need to condition yourself, right, as an investor to see when there is fear and blood on the streets, right, there is a chance for you to make a shit ton of money, right? That's why, there's a lot of people who say, like, China, will not recover and whatever, whatnot, right? Personally, I don't invest in China because, I've given my thoughts on it. I don't invest, but it does not mean that I'm not happy for a bounce because I'm happy that some people make money. I'm very sad is if people bought at the top and then, like, they lose 70%, right, of their capital investment evaporate, right? But it does not mean that I cannot be happy, even though I don't invest in it for it to bounce. Because if more than anything, I'm relieved that it bounced, right? And end
Mm-hmm.
of the day, it's about being able. If you are very firm and convicted in your investments, right, then honestly, less than 0.1% of the news, right, is usually big enough for you to actually take any action and for you to actually review your portfolio. Right. Ryan has been on the cleanse, I think, since last year. I think like close to 5 months right now. And
Yeah.
honestly, the only story that has made, honestly, if you really sit back as an investor, that really made me question whether or not my allocation is right, is honestly the Ukraine and Russia crisis.
Oh yeah.
That's really like the only story. Then when that broke out and when that happened, I took a step back and then I evaluated. So the process is I evaluated every single one of my positions and asked myself, should I change the allocation? Right. And the answer after the end of the exercise, I realized is no. And what you come to realize when you are in an all-in portfolio, right? As Ryan mentioned, the majority of your time is spent waiting for the investments to play out. And when there's a lot of this like so-called fear, uncertainty, and doubt, you will start to realize when you start to disengage yourself further and further away from the daily happenings, right? Even for interest rate hikes, that businesses which are good know how to navigate it, as what Ryan mentioned. You talk about inflation, you talk about interest rates. If you invest in a good company, right? I give you a very good example. What did Tesla do in the last week?
They raise prices.
Precisely done. You
That's
know,
that's exactly what I say about like it's the freaking CEO or the chairman's job to navigate the
yeah.
economic uncertainty. It's not your
So
job. Your job is just
yeah.
to hold.
So it's like if you had bought a fundamentally good company, which products you know that people want, right? Who gives a shit about the inflation rate and about the interest rate increment? Because end of the day, what will the company do to navigate an increased price law?
A
Right?
crazy good company would make money regardless of the economic condition. They will make money.
Yeah. They will make
You
money.
just have to trust them to do it.
Yeah, and end of the day, that is what investing is. Well, if you really want to get your hands dirty and do it, then you can just set up your own company, like, then don't invest, lah.
Yeah,
Right?
exactly.
The whole point of investment is so that you yourself don't have to be the CEO and like execute the business, right? That's really the whole
Exactly.
point. And what I find very incredulous, right, is when people get sucked into all this fat, then they try to think like a CEO, which to me, honestly, number one, you don't own enough percentage of a company to make any like executive decisions anyway. And honestly, if you have done your homework and you know that the people are good, right, good people, good management team, right, then you really shouldn't care so much about what fuck will happen. Because end of the day, like when the Ukraine crisis, the main questions I had to ask was not about business execution, because I knew that the business will execute, right? I knew that the idea will execute. The question I had to ask was whether or not this fundamentally changed the demand of the product going forward. Like whether or not this crisis, right, would dampen demand in the future. And for me, when I look at Tesla, I immediately knew the answer was no. When I look at Palantir, I was like, oh, this crisis happened, the demand went up.
Yeah.
Right, the demand for the product obviously went up. This is like a no-brainer. And then when I look at Bitcoin and Ethereum, obviously the demand went up even higher because people realize like they can be locked out of their bank accounts overnight due to some issues lah, right? So
Rug pulled by their own national currency,
yeah,
etc.
and I think end of the day when you are dealing with FUD, right, I think it's very important that you guys, right, don't allocate your time and emotions needlessly and stay invested emotionally, right, when FUD is not really a huge thing. I think it's very important that you don't subscribe and give a lot of emotional attention, right, especially emotionally, to things that don't matter. Because end of the day, when you look at mass media, right, their job is basically like YouTube, just in a more formal way, right? It's just to attract attention. They
Mm-hmm.
hope to get more eyeballs, and then their job is to make as much noise as possible so that you notice them. And the fact is, the world doesn't change a lot on a day-to-day basis.
No, it
Right, it
doesn't.
doesn't. It doesn't. Even like the Ukraine-Russia crisis, it's not going to like turn around in one day. It's going to take some time before things are sorted out. And you just need to know that this has happened and what has changed, and then you just need to accept the fact it's going to take time for it to solve. And you also cannot predict when it's going to be solved. That's a fact.
Yes, nobody will see it happening.
Yeah, nobody can foresee. I know for a certain fact this particular date the thing is going to like be okay. I say the fact is nobody knows lah, right? And like dealing with FUD, right? Actually, me and Ryan came to the consensus that dealing with FUD is quite simple. Just ignore.
Yeah.
That's really the answer. You can. It's like no matter how deep, like if you dig deep enough, right, you're gonna find problems, right? It's the
Oh,
same irony, right? It's like you stay in a barber shop long enough, you're gonna get a haircut, even though you're bald.
yes.
Right? So that's really how you deal with it, right? And I guess like okay, so the next let's talk about execution, right? What can you do during a downturn?
Just going back to like the FUD part. If you want any more information, we did like an episode with the guys from Ringgit $2
Yeah.
on FUD. So that's episode 2 of our podcast. Go check that out. Thank you very
Yep.
much. But coming back, what else can you do during downturns? Um, like we mentioned just now, downturns are always really good times to assess how the CEO is navigating the crisis, and also if you're in crypto, if the project stays on the roadmaps or not.
Yep.
And if they don't take it well, they respond very poorly, then it's probably time to sell and concentrate on other better ideas.
Yep. And
So
I would. Yep.
it's just conviction in the end, but yeah, if you have the conviction for it, go for it. But it's always a really good time to be critical and to be critical about the responses and yeah.
Okay, I think what Ryan mentioned about building conviction during downturn is a very good point. All right. End of the day, during huge drawdowns like COVID, during drawdowns like Ukraine, right? As we mentioned, take a step back and assess the situation very factually, right? And that's why during the COVID crisis, right, I took a step back, right, and then I start to assess potential acquisitions and the capital allocation, right? I'd really like to see whether or not the CEO, especially the executive decision, whether or not they make right decisions for the company in the long term. And I think one of the best examples I can give, right, during this COVID crisis is none other than Airbnb.
Oh yeah, I remember seeing one of your stories. Brian Chesky he actually refunded the money to all the customers, right?
Yes. And you know how I know this before he announced it? Because I rented an Airbnb during COVID.
Wow.
And basically the refund process was less than I think 24 hours. I cancelled my Airbnb. I came back to Singapore. I was given 100% refund, right? And
Wow.
then that moment there, right, told me that okay, this CEO is a damn good CEO because he understood the importance, right, of building a long-term business. He didn't screw his customer. And how did they solve the problem, right? They went IPO. They raised capital through the equity markets, right? And they did very well. And rightfully, they did very well because honestly, a CEO who has the balls to give everyone refunds and watch their revenue drop by 80% in 1 year, right? And playing the long game, that is a very good CEO and a very smart man because it's a little bit idealistic, I know. But end of the day, if you can make that type of emotional connection with your customer, there's no fucking way I'm going back to agoda.com.
Yeah. I mean, that's like the prime example of dealing with a drawdown. This guy had like a 80% drawdown on his freaking company, and not the stock.
Yeah, and I mean that by itself, right, should really like is as I mentioned, right, what can you do during downturns, right, is to basically identify what the CEO is doing during the downturn and then assess whether or not is it good for the business 5 years from now. I can
Mm.
guarantee you when they did the refund, a lot of the people who rent the flats were not happy, but he set up a fund to help them dampen the COVID downturn, right? And basically he did the right thing, and which is don't screw your customers. In 5 years the customers will come back because what is the number one tenant for a salesperson? You don't sell them just one time. You want to keep doing the repeat sale because customer acquisition cost is a lot more expensive than retaining a customer, right?
Mm.
And he did the right thing for the long term, and that's why Airbnb, I believe, in the vision of the next 10 years, or this is one of the company I want to buy, but unfortunately, my bags are already full, but honestly, if I didn't have any ideas, right, I would have probably bought Airbnb because I really like the CEO and how he actually navigated through COVID, and the results are out. His business has been going back to growth trajectory as expected. So another thing that ties to this, what else can you do during downturn, right? Is also a question about debt. All right, and I think Ryan, what do you have anything to say about the next question as debt during an all in, like during downturn, apart from what else can you do apart from conviction, right? What do you think about that?
I would say like that's a really fair point that you brought up. Um, down during when you're going all in or like during downturns, aside from like building conviction, one thing to really do is to make sure that you can continue to hold. When that goes back to managing personal finances. So if you've got nothing going on in your life, and then if you want to buy the dip, then yeah, go ahead, but if you have like something that's going on in the near term, say like 1 to 3 months time, you don't take the cash that you have in your bank and dump it into a bet that's going to play out in the next 5 years.
Yep, I agree.
But if we are talking about within the investments sphere, I would say rule number one is to never really leverage. Especially if you're in crypto, you're gonna get wiped out 100%.
Yep.
Everyone was wiped out. That analyst, really Wu, he was really confident that he won't get wiped out and on 42K, but he did.
Yeah, he got completely wiped out and stopped out.
And yeah, so that's why you just don't leverage if you want to hold. But if you really want to leverage, do it the right way. And that is to take like a loan from the bank. And your credit score has to be really damn good to do that.
Yep.
Aside from that, I would say leverage is not a really good idea unless you can get like a loan from the bank and you can pay it off. You manage to pay it off on time. You have like the income to support that, because you have to understand you are, or rather like mindful that you are sacrificing future cash flow for capital today. And that's why you have to be like sure that in the next X amount of time, that whatever your loan period is, you are able to secure income to pay off the fund.
Yep, it is boils down. I like what Ryan says. Where I like what you say when you go back down to like good personal financial management. And this is one of the things, right, that a person can do during a downturn. Because during a downturn, right, when the situation is very bad, right, if you have a lot of debt, then it's time, right, for most people to actually take a step aside and then ask whether or not they can restructure the debt. Sometimes the debt can be eating into your cash flow, and if your cash flow cannot support that, then sometimes it's good to take a step back, right, and then like reassess whether or not you can restructure that, because sometimes banks do give some leeway to restructure that. For a person who does not have debt during a downturn and he's out of cash, right, and then he can foresee that it's a very good buying opportunity, you still have to take a step back and acknowledge that it is still a gamble.
Yes, you are still
Because
timing the market.
yeah, because end of the day you are still timing the market. So a lot of people, I had many people who came up to me and during the COVID crash and asked whether or not it's wise for them to borrow money to invest into ideas lah. And number one, you are playing two things lah. The first thing is that you're borrowing money. Even if it's from a bank, right? The moment you borrow money, you're someone's bitch, lah. All right, like this is like really like the fact of the matter. You're someone's bitch until like you fully pay them back the money. All right, so that's number one. And number two, right, the investment idea has to be fundamentally good, because I had many people who come up to me, right, during the COVID crash, right, and then they try to give me this like investment ideas. When I look at it, I'm like, hey, look, the maximum return this thing is going to give you is probably like what, 15%. Then your borrowing cost is 6%. I say your margin of error is 8%. It's a shit idea, but obviously they don't want to see that lah. They want to see the opportunity that 8% is a lot. And I think it all boils down to, if you are going to borrow money, right, and you're going to invest into something, your margin of error needs to be big enough to warrant that risk. That's really the fact of the matter. Because if your borrowing cost, if let's say you're a accredited investor in Singapore, your borrowing cost is let's say 2 to 3%, and then you don't take on debt, which is like what Ryan mentioned, mark to market, meaning you can get margin called, right? You take a loan, right, which is like basically it's like taking a loan from a house lah. It's just that instead of a house, they give you that credit line you can pay over like 5 or 10 years, right? Then the effective interest rate maybe is about 5 to 6%. If your effective borrowing cost is 5 to 6%, right, in order for you to make sure that the investment return is good, I would say a healthy margin is at least 10 times of whatever you can you're paying for the interest rate. So if you're paying 5 to 6%, for me to take the loan and to invest into something else, right? At a point of time, it needs to be able to generate at least 50 to 60% in the next 5 to 10 years before I even think about taking on debt, because it gives me a healthy margin of error. Assuming, let's say, they don't hit 50%, even if they grow by 30%, I still in profit.
Yeah, that same goes to debt. If you take on like a debt for property, don't forget that you can get wiped out. That is what exactly happened in the '08 crisis.
Yeah, correct. Because it's a margin, it's a collateral loan, right? Because and coming back to this, there were many people I knew during 08, 09 who had they used to own like 5, 6 properties, right? Singapore, Malaysia, and during the COVID and during the 08, 09 crash, right? The banks called them up and say, hey, I need you to top up your collateral. And these people own 5 to 6 property. They just saw their property valuations drop by 50%. There's no way on earth they are able to hold on to a property. So they had to force sell and then foreclose, and then some of them end up declaring bankruptcy. Right?
Oh
So
man.
so end of the day, right, when you take on debt, right, I always go back to a key tenant. You're someone else's bitch until you pay it back. That's number one. And number two, if you are going to take on debt, make sure you know how to manage it very effectively. Don't like seriously, right? The number of people who get screwed by taking debt is the most of the time most of the time, right, people who get screwed in financial markets usually all stem from taking a lot of debt. And that is what I've noticed in my in my personal finance career lah. That's usually the case. The key tenant is always, it goes back down to bad debt management. But if you're able to manage that, right, then that is one of the things that you can do during a downturn, and that is to go looking for money. Because if, let's say, you're already all in and you want to take advantage, because as I mentioned out, you are very clear on the metrics, right, then basically there are ways, right, where you can raise money, right? It's
Mm.
not that difficult to raise lah, but this is like a level of sophistication that you must have. You must be very aware of your risk, and then you can take on debt. Just make sure the debt that you take on is manageable, right? Which is what I personally did in the last 2 years, and also what I did earlier on in my career. I did take on that to invest my money, but that's also because I'm very careful with it, right? And my credit rating has been good lah. All right, so so for people who have questions on debt management, right? Like maybe we might do an episode on it. If you're interested, just let us know, right? But I think we need to move on, because if we still have a Q&A section. So okay, so to summarize, right, to summarize, right, what to consistently look out for, okay, and what to reassess during all in, right, is that I'll just summarize for both me and Ryan, is that most of the time, right, when you go all in, right, a lot of the news, right, that really needs your attention is not something which is very noticeable. It tends to be something like Ukraine Russia crisis and COVID. Actually, that's really the two situations, right, in the last 2 years, right, that actually warrants any merit for a person, a long-term investor, to really take a step back and then assess the situation. That is really the two main news outlets, right, that the person needs to really look at: COVID and the Ukraine-Russia crisis. This is really like the only two major stories. Apart from that, in between, the inflation, the interest rates, right? If you invest in a fundamentally good stock, fundamentally good company, fundamentally good idea that's going to grow by 50, 60, 70%, the business is good enough and smart enough to navigate through all these issues, because that is what good entrepreneurs do, right? End of the day, that is really like the moral of the story. If you have very strong conviction, all right, all in, from my perspective, is always a lot better than holding cash, right? So what about you, Ryan?
I would say like aside from like reiterating your points, which is really good. I would say like after you go all in, there's really nothing else to do aside from like looking for um new income streams or raising your income. So
Yeah,
after you go all in, like personally, after I went all in, I began to focus on my career much more, like
yeah,
3 times harder as usual, because I freed up so much brain space
yeah,
to focus on my work. So I've been like working at least 12-hour days for the last couple of months, and yeah, it's been great. My performance has been pretty good, and it all comes from like time management in a sense, because when you go all in, you don't pay as much attention to the markets anymore. You got more time, more brain space to and more focus to channel towards your career or your business. If you're building like a separate revenues, like a separate business for like a side business per se. But yeah, it's all about personal growth for me personally.
yeah. I think that's a very good point that you mentioned, is that when you go all in and you basically just wait 5 to 10 years, what you're going to realize is that That's all, and you're waiting, right? Then you have a lot of this free time, right? Sometimes the best thing to do is just to go back and invest in yourself. I completely
Yes.
agree with that because even for myself, I think ever since I went back all in post COVID, right? Really, I've been really like focusing a lot on my own personal life as well and my own personal growth, and it's been great, right? Both me and Ryan actually lost a lot of weight. I think in the last like 3 or 4 months, lah. Right, and I think Ryan was like sharing me, oh, you lost 10 kg. I said, wow, great, man. So like, yeah, like seriously, life, there's more to life than just investing, lah. And you need just to just accept the fact, right, that investing just takes time to perform. Usually it takes at least 3 years minimum. That's the bare
Exactly.
minimum. Sometimes it takes five, sometimes it takes 10 years. But if you fundamentally buy good businesses, right, then eventually, it's going to pay off. I always like to give people the notion and the imagination. Be the person who bought be the person, right, who bought Apple, Amazon 20 years ago. I always give them the final thing. Don't be the person who bought Amazon and Apple last week and wants to sell today,
Mm-hmm.
right? Because end of the day, time does pay very well for good businesses, and there's always opportunity coming. So yeah, always like make sure don't forget to neglect yourself, lah. End of the day, that's the whole point of investing. You're making sure that people earn money for you and you don't have to work, because then what's the point of investing if you keep like 100% give attention, right? Then you don't focus on the other areas of your life.
Yeah. It's basically putting your money to work. You don't
Yeah,
you
you don't
don't
work.
chase after the money. You don't
Yeah,
trade.
yeah, precisely. I like that a lot. That's a very good takeaway. All right, so I think we'll move on to the Q&A. We have a bunch of Q&A which we found is going to be quite interesting and a large board of questions. So the first question that came up is the world worries that China will become a superpower. China is worried that they don't. And I guess the main question is, how do you obtain alpha investments in China?
Well, we don't. Me and Aaron, we don't invest in China. I used to, but I stopped because
Yeah,
this is a question going back to understanding geopolitics and the world order.
yeah,
So if you get the world order straight, it's always freaking America on the top,
yeah.
and that is exactly where I want my money to be. Period.
Yep, yep. Okay, number one, my advice is don't buy a mutual fund that buy high, sell low. Number two, number two, obtain alpha in China. Okay, alpha investment in China. Okay, I can share with you people who have made money in China. Okay, what they did. Generally, if you want to make money in China, right? The key is not making money. All right, the key is getting your money out. So when
Mm.
people talk about alpha investments in China, these people who make money in China tend to be very good at withdrawing money out of China, because what I've learned in my career, right, is the key to making money there is don't be a long term hodler.
Oh yeah, it's
Okay.
definitely short-term trades will reign over long-term hodling in Chinese investments.
Yeah, and what I've learned is you cannot use metrics and values that come from a capitalistic country, right? Like America, PE ratio, PS ratio. You cannot use this type of metrics to assess a country which is fundamentally run very differently. And I think this is one of a very huge mistake, right? That many people on social media, many people on YouTube, many people on Instagram, they buy China thinking that the system over there is exactly the same as the capitalistic country in America. So they use PE ratio, they use PS ratio to value the business as undervalued. All right. And I think this is one huge mistake that people are making, because fundamentally the two countries are very different, right? They are
Yep.
not of the same ethnicity. They have different national holidays, right? Both of them are humans, but the way the values and the culture are completely different, which is why like sometimes whenever I see Americans, they are so hard on into China, right? I really feel that they don't really understand the Chinese culture enough to make a fair assessment of what is actually like to do business there. Because when you do business with Chinese and you do business with Americans, these are two completely different groups of people, and the way that they do business is completely different. So it really brings back to buy what you know. Because the fact of the matter is, if you want to have alpha investment in China, right, then you need to be able to understand how these people operate, right? And honestly speaking, right, how many things in your life, the high value touch points in your life, the items come from China, you tell me. The fact of the matter is, right, if you are living in Southeast Asia, I would say that the most high value products that you're using are all come from America, not from China. The hardware, the peripherals, the hardware, they might be made in China, right? But how much of your interaction, the data that's valuable, actually goes to China? I would say that the large majority of them comes from America, right? So
Mm.
you need to be able to make alpha. It's really like timing, short term trade, and also like understand that the values are different. And that's how you assess it. Don't make the mistake of like assessing China like America, because they aren't. Okay, they simply are not, right? And they are two completely different countries, and then you have to like accept the fact, and and yeah, and really like end of the day, if you're comfortable with it, then that's your game. But personally, me and Ryan have both publicly said we don't own China, and I don't think we'll ever buy China, because that's just not our circle of competence. Let's put it this way,
Yeah, I
right?
mean
So
the values of the East and the West is very different. On the West, we've got very capitalistic values. Everyone's out for themselves. But in
yep,
China, common prosperity is the thing. So
yep.
if like us, we don't understand common prosperity at all, then you better not touch uh Chinese investments.
Yeah, and even though Ryan and I ethnically we're Chinese, right? We also don't consider ourselves China Chinese like at all, right? We culturally we are not China Chinese. He's
No,
Malaysian, I'm
definitely
Singaporean,
via
right?
no, no.
Right. So like even then like the West people they see the same as though we're Chinese. They group us the same. I say it's not. It's like comparing a Mexican and American and a person from Canada. It's like completely different. They look the
Yeah,
same, but they're completely different, right? So
the
don't
culture is
think
different.
that yeah. So don't think like just because ethnically everyone is Chinese means that it's the same value. It's completely different, right? So I guess the next question, moving on, right, is how do you decide the portfolio allocation percentage in terms of geography and industry and asset class?
For me personally, it's always growth rates, the growth potentials. I don't
Yep,
really mind if it's just one or two asset classes
yep,
or a single industry. Because if you look at my portfolio, the core holdings. There's only four things: Bitcoin, Ethereum, Tesla, and Palantir.
yep,
And if you boil down to industries, there's only two things: AI and blockchain. Asset
yep,
classes, only two things: stocks and crypto.
yep,
So it's a matter of like conviction, concentration, and most importantly, growth rates.
yep. In order for me to answer this question, right, why I choose a narrow niche instead of going broad is because I don't want to fall into a trap of diversification, right? End of the day, I think you need to invest in what you know. So if you know it very well, then I think it's fine to you have to have a high percentage. But at the same time, right, if you were to go back and look at the best investors of our time, right, you take Warren Buffett for example. If you remove 10 of his best investments in his career, right, he would have underperformed the S&P 500. All right. And when you decide to allocate a percentage of your asset class, right, in your 20s and 30s, I think end of the day, what you should be looking for is time horizon that is a lot longer than people who are in their 50s and 60s. Because when you are in your 20s and 30s, the luxury that you have is that you are a time millionaire. You have a lot of time, right? 20s, 30s, man, you guys have like so much time on your hands, right? Like when I first started, there's no such thing as Tesla, right? But there was Amazon, there
Apple.
was Amazon, there was Apple, and these are the growth industries, right? And halfway along the way came out Tesla, which I stupidly didn't buy, right? And halfway came out there was Nvidia, which I also didn't buy, and those went on to become 100 baggers. They went to 100x their valuation when I first took notice of them, and I didn't buy them. So a lot of people who are very worried about like missing the boat, right? And then they want to FOMO in. I can tell you, opportunities will come. That is pretty much like the rule of the game, right? Like nobody would have foreseen that Tesla would grow into $1 million a car. People were in disbelief, but in the end, he did. He did execute. So I can say that going forward, right, brilliant entrepreneurs, right, will continuously come, and that's why when you look at Bill Gates, he always says the biggest worry that he has is always a person in his garage working on the next big company. That's always his biggest fear, because that's where he started, right? He was actually trying to fight IBM back then. So how I allocate is very simple: conviction, growth rates, and end of the day, I think is really highly concentrated into as little positions as I can, because end of the day, when drawdown happens, right, that is when is the barometer lah. When you feel nothing, then you know that allocation is right for you, right? Like if I were to invest a significant portion of my money inside China, right, and it draws down by 70%, I can tell you I'll feel like shit.
Yeah, I'll probably piss my pants.
Yeah, I'll really feel like shit because I don't have any conviction in China, right? And it's the same for value stocks because I used to be a value investor. I can tell you when my value stocks are draw down by 80, 90%, I can tell I feel like shit. If it's draw down by 50%, I can tell I feel like shit because I know value stocks, right? The moment they draw down 50%, it's going to take them 5 to 6 years to recover,
Yeah,
right? But
that's very
if you
true.
have a high growth stock, you know, even if it draws down by 20, 30%, I don't give a shit because the
It's gonna
future is
bounce
bright.
back soon enough.
Yeah, and because the future and because you can depend on the growth rates of the company to save you, right? And usually growth rates are they tend and usually such companies are they learn how to basically grow and change and evolve as they get bigger. Like what Warren Buffett did to Berkshire Hathaway. You know, he started reinsurer. Right now he's one of the mega renewable energy powerhouse. Right, he planned for the future, and great entrepreneurs they know how to pivot and grow the business as they age,
Mm.
right? And that's something which you can depend on if you buy very good businesses, lah, right? Instead of focusing on a lot of stocks, then end of the day you have a scalability issue, right? So I like this question. Advice for a total newbie investing in their 30s. Like what advice can you give, Ryan? For example, I'm a complete newbie in my 30s. I want to start investing. So what advice would you give me?
Well, I'm definitely not in my 30s, so I'm really curious about this as well, Aaron. Maybe you want to take this one.
Yeah, in my 30s, unfortunately. Okay, I think the difference between people who are in their 20s and people who are in their 30s, right, is that people in their 30s, right, we already know pretty much like how to make money. So I don't think income is usually an issue for us. I think the main issue is how do we best allocate our money because I think most people in their 30s, right, they're trying to search what is the best asset class that they like, which is very difficult for most people to answer. You know, for me, I'm quite lucky in the fact that I knew from the get go that stocks is what I want to do. I'm not interested in property. It doesn't mean that I disregard property as an investment class. It's just that I just know that my natural affinity is with equity and investing, right? And that's where I thrive. And if you ask me to do investing in property, I can tell I'm going to give you a shit return because I have no interest in it. So, end of the day, I think for a total newbie, right, I think what's important is that don't be attracted just by the return. I think it's important that you go to a place, right, where you are very interested in because that's when you are going to learn the most, right? I picked up my first investment book when I was 18, you know, so I've really been doing this for so many years and I have totally not lost any interest in it. You know, I've been doing it for so long and every day, you know, I'm still very interested in investing. I will still read like books, history books on like markets and financial markets because I love it, right? I enjoy it. But you ask me to do it for property, I can tell you I'll fall asleep. I just don't have that ability to like go so deep, and that's why I don't touch it because I know I'm not going to do very well in it. So end of the day, right, in your 30s, right, I think if you're talking about like starting out as a newbie, right, I think it's very important that maybe you try starting out in index funds first. You can try the VOO or the triple Q, which is basically the Nasdaq or the S&P 500. I think that's a very good place to start just to get exposed in it and learn how it works. And then as you start to get more and more advanced, right, then maybe you would want to go and pick up a few. In fact, don't even pick up investment books. There's many content online which you can listen to. Our podcast is one of them. You know, ringgit to dollar is also pretty good, right? And try to listen. I also like Chicken Genius because it's pretty good at explaining difficult things in a very simple to understand manner, right? And then just get comfortable with. I think end of the day, you know, in your 30s, right, you have a lot less time than a person who's in their 20s in terms of compounding years. So I would say that you need to be very selective, right, over the content that you consume and grow from there because you don't want to be spending 10 years in your 30s just learning and never executing because end of the day, you know, you don't get results by learning, you get results by executing. And I think the fastest way is to put money at risk because that's when you learn the fastest.
Yeah, I like how you said don't rely on investing books about investing to learn investing, because a lot of times investing is learning about business, and investing is more relevant today is learning about the tech behind the your investment, be it AI, be it um your blockchain, you know. that's the thing that you want to like read up if you're going into that space. Because like say if you're interested in Airbnb, that would be understanding property, that would be understanding um the tourism industry. So that is what you need to understand
Yeah,
instead
and
of like going in for the books. Not all books about investing is created equal. They are not by means one size fits all for everyone. And yeah, you know, I have like this list about like books to learn, to read about, to read before investing, um and it absolutely has zero relations to any books that teaches you how to invest. Not books like Intelligent Investor, or not even like Peter Lynch
yeah.
and his books. It's more about books like Zero to One, you know, how you build a $1 million, $1 billion business ideas, that kind of stuff.
Yeah, and seriously, honestly speaking, I can tell you that you should not be looking into books, right, as the finality learning journey. Because end of the day, I've been doing this for more than 10 years. I'm still learning every day as an investor. You know, investing is a very personal experience that each of us go through because it takes a very long time, right, for you to realize what type of investor you are, because that might change as you age. You might be a value investor like me when I started in my 20s, but I evolved and changed into a growth investor because that was a personal journey that I took, and I understood why I'm now a growth investor. So whenever people ask me like, Aaron, why don't you do Excel sheets? I say, yeah, I've done it lah. Like you can throw me as many PE, whatever ratio. I say, you think I can't do it? I can. Right? I've been doing this for 10 fucking years. You think I can't do it? I can. Right? I've done it. I did it fucking manually before you guys even had Excel. Okay. I did it fucking manually on a piece of paper and notepad. All right, and I calculated it manually. So
Yeah.
for people like for people who think I can't, I can. I've done it way longer before the people started, right? So it's like I can do it, but there's a reason why I'm a growth investor and why I took this approach. It's because I did the legwork many years ago, and I just transited to a point where I'm very comfortable being a growth investor. All right, and it's something which is very personal. All right, and I think you just need to accept the fact, right, that investing is a game, right, which you never stop learning. Because the fact
Mhm.
is, investing is a game where the world keeps changing, right? 10 years ago, it was Amazon, it was Apple. Now it is Tesla, it is Bitcoin, it is cryptocurrency. I'm very sure 10 years from now we have something new, right? Because that is pretty much like, if you really like were to understand how investing works, that's how the world works, right? In
Mhm.
1980s, there was the personal computing, there was Microsoft. Then 1990s, there was the dot-com bubble, and now we have like NFT, whatever nonsense. Like 10 years from now, something new will come out. So I think the key point is to always keep learning and be open to ideas, because end of the day, you don't want to be so hard into like old values. Then you end up just holding on to values that might not even be relevant like going forward, because end of the day, you make money in the future, you don't make money based on what you see in the past.
Yeah, definitely.
Yeah. So the next question is property under mortgage. How do we quantify percentage of the portfolio? So for example, I think the situation is that if you are having a property mortgage, whether or not you're living or whether or not you're staying, how do you quantify that as part of portfolio? It's very simple. You just take this one I can answer. Basically, you just take what's the property value, right? Then you minus away the loan outstanding, right? In fact, I won't even do that. I'll still take the loan outstanding, because end of the day, when you take a loan, it is actually property of your future income. So I think, for example, if you have a property that's $500,000, right, and then if your net worth, including your cash, whatever, is, let's say, for example, 1 million, right, then I would say I'll quantify the portfolio as 50% of your total portfolio, right? I think a lot of people like to do accounting analysis in their head, where portfolio is one thing, then stocks is one thing. I don't actually like to take that approach, because I think that's an opportunity cost. When property takes up 50% of your portfolio and you don't acknowledge it, right, then that's a problem, because you are making an active decision with your future income, right, to invest in this property.
Yes.
So you
Yes.
have to acknowledge and admit, right, that it is taking up 50% of your opportunity cost. Because if you don't admit and acknowledge that, all right, then the problem is that 25 years from now, you're going to realize, right, that the opportunity cost of holding so much property might have costed you more than $1 million if you had used the opportunity cost to invest in something else.
I mean, for me personally, how I look at it as is that properties, I'm not against properties in general, but I have a problem with like taking property as investments. If you buy and like own to stay, that's completely fine, you know, because property serves the need to have a roof over your head, It's a space that you live in, that you unwind. And splurging $500,000 or $1 million even on property is completely fine if you can afford it. But like it goes back to like what Aaron says, it's illiquid, and you can get like a mortgage, like the margin call if a crash happens. And in general, it's still like just wise to acknowledge you have that percentage of debt. It's really just personal finance accounting, I guess.
Yep. And acknowledge it lah. I don't think it's wise for a person who has a lot of money every month to pay a mortgage to not acknowledge that it is an opportunity cost, because it is still money that stems from your cash flow and your future income, right? And that's how I would
Yes.
do it. All right. So the last three questions is this question is interesting. And why did you go all in?
That's one from me, guys.
Yeah.
So I'm
Uh,
always like really interested in studying like the mindsets and the mental states of people who's got balls to like go all in on a single thing. People like Jeff Bezos, Elon Musk, and in our investing realm, people like Aaron is like who transition from like value to growth and goes all in at it is extremely rare. I don't see people who preaches growth and going all in as much as Aaron. So I'm always very curious.
yeah, I
So
would say Chicken
Aaron,
Genius
why
is one
why
of
did
them.
you go? Yes, exactly. Chicken Jays is also one of them, and that's why I watch his videos a lot as well.
Yeah, okay. So why did I go all in? Very simple. The answer is throughout my experience in the last 10 years, right, I have come to the conclusion that I cannot time the market. And even if I seem to be able to time the market, the fact of the matter is that I got lucky. I think that
Mm,
is really like the fact of the matter. Every single time people always say my timing is good, the fact is I got lucky, right? Because I think it boils back down to the fact, right, that in the earlier years of my investment career, right, I did a lot of this like value investing where I was getting returns of like 50, 70% every year, right? My compounded rates when I was like in my early 20s, sometimes was 100% a year, sometimes was 50% a year. But then later on, I realized that I would have done a lot better if I had just all in Amazon. And that is the fact of the matter, because when I first bought Amazon to today, Amazon had 30x back then. I was doing so much work, into looking for this like so-called undervalued securities. Then I realized what Warren Buffett did and what Peter Lynch realized early, mid. In their careers, and what Charlie Munger has been preaching all the same time. If you buy a very good business, right, the upside is pretty much unlimited because the growth potential is unlimited, and that's why I decided to go all in. It's not like I've not been all in before lah. This is the first time that I've been all in and take very concentrated bet, because number one, I was waiting for opportunity, because like before that, right, I always felt that because as a value investor that I was always looking for something which I can sink my teeth into. Like I really needed to like find something that I can sink my teeth into. And then the opportunity of the crash, right, gave me the opportunity to actually like allocate 100% inside, right? And then that happened during COVID lah, which is something which is lucky because I couldn't predict that, right? And I went all in because my experience has taught me, right, through very painful experiences of missing things like Nvidia and Tesla, and even Amazon for that matter, that the best way to go forward in investing, right, is to basically look for very high growth businesses which are fundamentally good, all right, and then concentrate your investments. Because
mm.
that's the fact of the matter. Because I would have done a lot better, right, and just ignore all that nonsensical like value investing and just buy one stock. Yeah,
Yeah, that's
and
very true.
yeah, and really like that's why that's my basically like magnum opus lah. That I came to this like I went one huge round, right, over the last 10 years and came to the final conclusion. It's better to just buy high growth businesses, not give a shit about it, and reevaluate every time there's a political or geopolitical issue. Because end of the day, if the business is a very high growth one, people say, oh, Tesla is down how many 30%. I say, honestly, do you give a fuck if Tesla has 100x over the last 10 years?
Yeah, exactly.
Like you tell me you're waiting for a crash. I say, let me tell you, I say any people have been waiting for a crash for like fucking Tesla since 2013, right? You think people who bought in 2013 or 2012 Tesla give a shit about this like 30% downturn? They're still up more than 100 times,
Yeah.
Right, so it's like whenever people tell me like, oh, all in is risky because it can crash. Yeah, but if I already 100x my money, even if it crash, who gives a shit? I'm really like I already added 2 zeros to my balance sheet already, what?
Mm.
So like, I think a lot of people just I think it's important to just admit that you cannot time the market and just fundamentally go back to the idea. My first question now, can this 10x and can it potentially 100x? Because that's where that's when I'm very interested in. And that's how you do investing, right? You take time and just accept the fact that it takes time for investments to grow. And also you need to accept the fact that, markets go down 20%, 30% happens.
Definitely.
So how about you, Ryan? Why do you go all in?
Oh, for me, it's not because I had like the conviction to go all in. I just happened to build conviction along the way. The more I read into the FSD of Tesla, the more I learned about how Palantir is it is like changing the data game. The more I understood crypto, I just built the conviction, and I got to the point where I'm like, I don't want to waste any more time. And I just decided to all in and then go live my life.
Yeah, and if you actually look at the drawdown, right, like honestly, even if it's 50%, if the thing is going to like 10x, 20x, or even like potentially 100x, right, it's not going to make much of a huge difference when you're already quite wealthy, lah.
I
Fact
mean,
of the
just
matter.
going back to this point, right? Even I didn't like hodl for 5 years
Yeah,
for like the crypto and like whatnot. I'm still like just 2 years in of
yeah,
my like holding. I'm still sitting in on profits after all this drawdowns, except for Palantir. But like for the ones that I started investing in like 2020, say like the Tesla,
yep.
Bitcoin, and Ethereum, I'm still sitting on very comfortable profit margins. No, not to say margins, but it's like I'm still there's like a nice margin of like the profit that I'm sitting on. So the longer you manage to hold, the longer this cushion of like profit grows, and the less anxious you will get.
Yeah, and I think that's when a lot of people like they fail to see that it takes time for your investments to work. This is not a get quick rich scheme. If not, everybody don't need to work, right? It's not like you buy this stock,
Yeah,
then
exactly.
tomorrow it goes up, So it's a long game, Just understand that it takes time for businesses to grow. Nobody starts a business today and expects to be as big as Amazon tomorrow, unless you're Theranos. Okay lah, no lah, not true lah. Theranos you also had to hustle quite a bit, but that's a story for another day. Okay, so the
Mhm.
next question is, were there any changes in your psychological or mental stage after going all in, or how has your view of your investment changed? This one is also asked by Ryan. Were there any changes in your psychological or mental state after going all in? Honestly, I felt better. Funnily enough, I don't think many people can come to the same conclusion as me because I paid the price in the last 10 years. All right. I can tell you that my mental and psychological state of being all in is a lot better than holding cash.
Mhm.
Because the problem is, right, if you understand investments, you also understand the problem of opportunity cost. And if you hold a lot of cash and you see a lot of these investments grow, right, and then you are making a mistake of not acting on it, and then you're looking at money going up, when if you had put the trigger, you'll start to realize that mentally it's a lot more comfortable, right, looking at a 20% drawdown and investing for the 5 to 10 years than to basically just because of that 20% possible downtake, right? You don't invest your money. Personally, psychologically, and mentally, I have felt a lot better going all in than holding in cash. That is the fact of the matter because I can tell you, holding cash before the COVID was not a fun experience for me. Like I tell you, I
Mhm.
hold 95% cash. I can tell you that feeling is quite shit because it's like, you're always praying that the world dies,
Yes.
and that is fucking like a pessimistic, It's like this is why whenever you see people like Jim Rogers, people like Michael Burry, they're fucking like doomsday predictors because every single and this is what you become, If you are a person who keep holding cash and waiting for a dip, then you become a very pessimistic person in general, You're always hoping that the world fucking dies, the world fucking crashes, the world fucking like goes to shit, right? And then you will never make money because end of the day, guess what? The world always gets better.
That's
The
true.
standard of living increases. The last 10, your parents' time and your time, the standard of living, the life expectancy has increased. So if you are going to bet that the world is going to shit, right, then I honestly feel that you should, it's just a wrong bet to take, lah, because I can guarantee you that in the next 50 years, right, our standard of living will only increase. That's a fact.
Mm.
We always trend towards a better standard of living, higher life expectancy. Medicine is going to get better. And then things are going to get better and cheaper. So I don't want to take a bet of holding all cash, because end of the day I'm going to end up being a person who's like fucking pessimistic, right? And then hoping that the world dies and goes to shit, because just for me to make money.
Yeah, I mean, like, look at Michael Burry. He made so much money over the '08 crisis, but in the expense of people going bankrupt. I mean, how does he feel? I'm not sure, but I don't think I would feel good in that position.
And if you actually were to look at Michael Burry's fund performance in the last 10 years, he has underperformed severely the S&P 500. That's a fact.
Yeah, that guy can only shot. Let's just put it that way.
Yeah, so it's like, I think end of the day, like psychologically and mentally, I just felt better lah, because I studied long enough to know that this feels a lot better. Being on the side of hoping that society gets better, right, along the way, and knowing and being optimistic about the future, right, translate to better growth personally, in my life, because I also start to perform better in my career. I start to perform better in my relationships. I start to become a better person in general, because I'm a lot more optimistic, right? And I start to see the world as a world of abundance rather than scarce. Because if you are always hoping for a crash, right, honestly, you have a scarcity mindset, and that's a fact.
Yeah, and scarcity mindsets are quite negative, and it's quite destructive in general, not just to
Yeah,
you yourself, but also for people around you.
yeah. So I think this is a very good question, lah. Like, how about you, Ryan? Like, were there any changes in your psychological and mental state?
Yeah. At first, initially, definitely, because I didn't go through the whole value investing cycle before I got into growth, because it was like a rather short period that I invested with like value investing methods, and I didn't think it worked out. For me, it didn't make sense for me, so I just went with growth investing from the get go, and then after going all in, it felt like a step into uncertainty, and because it was pretty much early on in my investing journey as well. It's just 2 years in, so for me, like it was a conviction check personally, and then yeah, and initially it was quite bad, and then with all the fun and everything. And that's kind of like when I got really annoying, and I was like, oh shit, 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 shit. Every day, something is happening on the market, and I'm freaking out, pissing my pants all day, every day. But eventually, after the content cleanse, and just getting my convictions in check with my holdings, I honestly feel better. And the point about transitioning from a scarcity to abundance mindset was really important. I really like that point, because I personally had that mindset shift as well. Because when you have like when I went all in on like these high growth investments, I just see that there's like really no short of opportunities to earn money if you place your bets right.
Yep, I agree.
So yeah, it's like for me personally, as a newbie, I transitioned from like fear of uncertainty to like building confidence, and now I'm perfectly fine.
Yeah, and that translates to like better overall life lah, I would say. And I
Yeah.
completely agree. Yep. So okay, to end up, we have one last question, and is, where did you find courage to go all in? Maybe Ryan would like to answer that.
Oh, it's a question for you by me, but personally, how did I find courage to go all in? Like as I mentioned, like just now, for me it was a step into the uncertainty. But I know I'm young and I can afford to lose in certain ways. Because when I started going all in, my portfolio was in the ballpark of like just scratching six figures.
Yep.
So I mean the money that I made in 2020 and 2021, 2020 especially, did not feel real at all. I went from four figures to six figures actually.
You better
So
performance than than the fund mutual fund manager.
but because I when I like look back, it was all just really good capital allocation, and just like realizing my mistakes and acting fast on it, and I decided to like just ride with this momentum that I had from like 2020 and 20 into 2021, and I just took the shot into the darkness, and I yeah and I it and the rest was like history, like me feeling kind of like shit when FUD was like happening, and then like content cleanse, and like now.
Yeah. Where do I find the courage to go all in? I think end of the day is a culmination of experience. It's a combination of staying calm and knowing that eventually things will get better. So I wouldn't say that I'm courageous. I'm just making a very calculated bet because I think courageous just means that I'm hoping for something. I'm in fact I don't really hope for something. It's more of a point of view, right? When I just know that uh, things will get better because I have the luxury of experience, and that experience has taught me that no matter how bad the news like to proclaim it, right, that eventually, right, things always get better, right?
Mm,
And
yeah.
I think a lot of people and I think the media has managed to condition many people to believe that the world has a lot of problems without pointing out the fact that there are many good things that happens in the world as well. There's a lot of positive in the world as well, and that allowed me to like believe that eventually we get better lah, right? So this is why if you look at all the biggest companies in the world, right, they tend to have a lot of positive fuel energy inside them. They always point a better world. They always point towards a world that's a lot more positive, and usually it's not a world that's filled with shit, right? If you look at Tesla, you look at Apple, right? You look at Airbnb, they always point towards a world filled with opportunities and abundance, right? They don't like give you the story that the world is going to shit, etc. And that is what the world is like lah. Money always flows towards people, right, who see a vision, works towards it, execute towards it, and makes the world better. And these are ideas which, as a capitalist country, right, allows people to participate in that wealth growth. Because the fact of the matter, if you really go out and and seriously look, right, honestly, it's very difficult to find a person who's always very positive. It is positivity is a scarce commodity lah. So if you manage to find it, right, then basically that is something which can be something that can be capitalized on lah. And I think the courage, I wouldn't say I'm courageous. I'm just being very factual about my investment decisions. And the right decision for me is to go all in, right? Because end of the day, I know I'm going to be fine. I know I can make money. I know that my personal finance is like in super good shape, right? Even though I have debt, I know I can manage that. So I don't really foresee a situation, right, where I need to like I'm not in a situation where I'm going to have like personal financial issues. I'm just not in that position because end of the day, it just comes back down to how much confidence you have in yourself. And I think,
Mm,
I've come to a stage right now in my life where I'm just very confident in the fact that I know how to get out of situations if they're bad. Because I learned from experience I'm quite flexible in like financial matters lah. And the fact is I'm good at it. So I won't say I'm courageous. I'm probably courageous more in 2010 when I didn't know anything, right? But right now, at 10 years later, I'm quite comfortable in like making big decisions, right? Because it's like the same as what Chicken Genius did lah. He also went all in, right? And I can tell you, I can probably reflect his journey because I think his journey is similar as mine because it took him probably 10, 15 years, right, to come to the conclusion that all in is the right thing to do lah. It's not overnight lah. For me, it took me, I've always been all in, but I've never been all in so comfortable before in my life. Yeah.
mm.
So I don't say that I'm courageous. I would say that I am calm. I'm calm. Yeah.
I like it. Calculated moves rather than courage. I like that.
Yeah, so that's the best way to answer lah. And obviously, both of us hope that you listeners, you will eventually get there one day. To summarize, just understand that it is not an overnight journey. For Ryan, it took him about 2 years and lots of like media cleanse and a lot of therapy sessions, personally, for him to get to a point, right, where he's very comfortable to allocate investment. So don't expect yours if you're new to this. Don't expect for you to get comfortable in overnight. It doesn't, like for me, it took me like 10 years to get to a point, right, where I'm very comfortable. And that's because yeah, like that's how long it took me. For Ryan, he's a very fast learner, so it only took him 2 years. So
But
so
my mental state was volatile as well.
yeah, he was very I would say like in terms of learning curve, Ryan definitely learned it faster than me, lah. Right. So anything else you want to say, Ryan, before we sign off?
Yeah, I'll just say like going all in has its benefits, but it's also not for everyone. Boils back down to risk appetite and personal finance management. And it does but if you ask me to like do investing in another way, I would probably just go back all in one way or another. So yeah, as always, invest safe and yeah. And also one last thing, I would just like to extend my compassions and sympathies to people affected by the Ukraine Russian aggression. I know we are talking about this situation from an investing point of view, which is slightly incompassionate in some ways. But yeah, just know that we are sympathizing with people that are affected here, and we pray
Yeah.
for your well-being.
Yeah, definitely. Our hearts definitely go out to people who have been affected by the Ukraine and Russia crisis. We hope that people will get better in that situation. I hope that it faster gets resolved as soon as possible, so that people can move on with their lives lah. Honestly, innocent lives being taken, innocent lives being thrown over should not be the answer. So let's pray and hope that people will get will overcome this lah. And I do have, as ever optimist is, I believe that we will. Right. So last views for me on all in, just understand that no matter which asset class you choose, cash, property, or stocks, just understand that you are always all in something. And that is something which you have to come to terms to. If you're not investing your money, you are all in cash. So end of the day, it's good to reflect, take a step back, and always make active decisions. Right, so this is our episode for the All In podcast today, RA21. We hope to see you again. You can follow us on Instagram. For Ryan, is Books and Stongs. For me, it's Aaron Goes Global. And our podcast is available on many platforms. You can just find us on Anchor. And we'll see you in the next podcast.